Thank you so much for that. I mean, this is exactly what I was looking for, and I did have a list of some questions, and you talked about quite a few of them already, but I'm maybe going to ask you to go a little bit deeper into the most popular ones. So I did a couple of social media polls over the past couple of weeks getting ready for this, and the most popular question was still about COVID. I know as our country gets all these vaccines in us, and there was a major disconnect last year between the stock market and economy. And I know that you and Brian Westbury were talking a lot about COVID last year, and people are still worried whether or not the economy has any pitfalls if there's as we get through COVID. So do you see any risks in the stock market or the economy, and how would you explain the difference between the stock market performance and the economic performance last year?
Yeah, I think it's pretty fair to say that the economy is certainly performing better now than it was 6 months ago, or certainly a lot better than it was a year ago. We didn't have 8 million job openings 6 months ago or a year ago. So I think that, basically confidence has improved a fair amount at the consumer level, at the business level. I think the stock market is always looking ahead 6 months or a year, 2 years down the road. And so a lot of times the market does things and people see what's happening near term. But I think it's pretty fair to say that what the stock market is looking at is what they think that things are going to look like a year from now, 2 years from now. So the stock market, the fact that we've been hitting new highs in the Dow is telling us, look, things are going to get better. The outlook is going to improve. The stock market is very much a discounting machine, and it's not that we don't have issues out there. I think these supply-related problems that we're having are real, and I think we have injected a lot of cash into the economy. We've got government spending at a very, very high level. All these different things, in the end, are going to have to be paid for. Well, the way you have to pay for them is through an economy that is growing. So I think in the end, I think the stock market sees it, but we still have a lot of money sitting in cash. A lot of money market fund asset levels are still very, very high. A lot of folks are still playing defense. And what tends to happen in a bull market is we have this recovery in the economy, and it's not really until the end of the cycle that investors start to feel like they're missing out. And I don't think that we're there yet. I think that we're still very much in the early stages of this economic rebound. It's going to take, probably a good 6 months, a year, maybe even a year and a half before we get unemployment down to levels that were in the range of where we were before the whole slowdown. It's going to take some time. I think, when you shut down the economy, to the extent that we shut things down, it's hard to get things restarted. It takes some time, and I think in the end, the stock market is telling us that the equity markets are telling us that the economy will figure this out. We'll get our act together. I think probably the biggest risk down the road is that the Fed finds itself behind the curve. In other words, we have more inflation than the Fed has been anticipating. Investors start getting restless in the bond market. We see yields going up on the long end of the curve, and eventually the Fed starts to raise rates, and maybe they have to raise rates more than they want to. And that's typically what we see near the end of an economic cycle. And it could very well be that cycle doesn't go on for 8 to 10 years like it did the last time. Maybe it's maybe more of a 3 to 5 year kind of a cycle before the Fed is put in a position where they have to raise rates to cool the economy down and get inflation under control. So I think the bond market is giving this surge in inflation that we've been having, whether it's in oil prices or lumber, all these different things. I think the bond market is telling us that it thinks it's going to be fairly temporary. If it turns out that's not the case, that's probably the biggest risk of the market right now.
I agree completely. And one of my big takeaways from a few slides ago was when you talked about the pent-up demand in healthcare. I've been preaching the story about pent up demand in the economy, and healthcare is not what I was considering. I was thinking about, my family wants to go to Disney World, and all these people looking to get out and back to life as normal and return whatever normal is. And you overlook the fact that so many people, there's pent up demand in the healthcare system. So that was an amazing observation. I appreciate that.
Yeah, a good friend of mine is a doctor, and he's a anesthesiologist, and he's like he goes, we are, one of the most predictable things is just how many surgeries people get during the course of a year, and you could see he said he did 20% fewer procedures last year than he did the year before, and he's like, you worry about people not getting care, and that may be one thing that is overlooked, as you said. I mean, people, you think about the fun things about getting back to normal. I want to go to restaurants. I want to go on vacation. All those kinds of things. I want to go. I love. I'm a music guy, so I love concerts. But I think in the end, I think there's a lot of us, especially a lot of us that are baby boomers, are like, boy, we haven't probably been getting our physical things taken care of like we should be getting them, and our healthcare related things. And I think I think it's going to be a very busy summer. I think for a lot of doctors and in healthcare facilities.